Viktor Katona is lead crude analyst at Kpler and joins us now. Victor, really good timing having you on the show because there are a lot of conflicting issues. Look, all the protestations of supply squeezes have so far proved utterly wrong. All those commentators who I value, many of them as well, and they're seasoned OPEC analysts and seasoned energy analysts, are wrong. The oil price is substantially below $90 a barrel. It is not substantially above $110 a barrel, as those geniuses told me it would be. Why are the analysts and the energy experts getting this so woefully wrong on products at the moment?
Well, first of all, I think that a lot of people have their own agenda. So you should never discount the fact that the people would actually just talk their book rather than analyzing thoroughly the market. And the second of all, I think that people underestimate the boundaries of human creativity. I think we will see this with the product price cap specifically because there's an overwhelming assumption that this would be a huge disruption to everything. I don't really think this will be a transformative event. I don't really think that this will have the impact that a lot of people can imagine. And the main driver for this will be actually human creativity and you know, the constant search for a new solution, for a new supply chain or for a new route. And this will bring us basically into the same story that we had with the oil price cap back in December. People expected a lot of things. In the end, it never really happened.
Victor, I think you're 100% right. It's not often I say that about it, guys. I think you're absolutely right. I think the innovative ability of people to find other suppliers, to use substitution, and actually to conserve and not use as much energy has been in spades over this winter as well. But when the experts, again, the same group of people, and I'm putting them all together, say there's a problem, they say it's on product as well, and it's on refined product rather than actually the raw material itself of crude that where we're going to see the problems. Are they wrong on diesel as well?
I think they are. And I would say that the main development of the past 2 weeks when it comes to Russian diesel has been happening not in Europe, but in North Africa. North Africa will receive at least 6 million barrels of ultra-low sulfur diesel from Russia. And that's roughly a quarter of what the European Union used to be buying. And because North Africa is never really member of the oil price cap coalition, you know, the substantial transformation clause that the coalition still kept for products, basically, you know, you basically drip one droplet of something else into a cargo of Russian diesel and it's already Moroccan and it's already Algerian and it's already Tunisian. All of these countries have seen quite a substantial uptick in Russian diesel flows. And our expectation is that, you know, February the 5th kicks in, there will be a lot of flows from North Africa, basically Russian in all but name.
So, Victor, can I ask you what this means on pricing? There is a view that Middle East customers still buy up some of this product and Asian customers as well, but it is at a discount. So what does that do in terms of the amount of income Russia could expect?
Well, I think we'll have a very similar story to what we had with the oil price cap, and namely that the supply chains, the transactions, and the actual companies involved in the transaction will get longer. A lot of those companies will be non-Russian based, you know, be it Dubai, China, India, basically you can make wherever. And the Russian government will lose quite a substantial amount of revenue just because the supply chains have gotten longer. The shipping companies are all based in Dubai or in India or in China. And basically the Russian government will not see this revenue. On the same page, I would say that the Russian oil companies will not get any significantly, poorer. I would genuinely believe that their revenue would be roughly the same that it was in 2022, because in 2022 they also traded at discounts. So it's not really a novelty that they are trading at discounts. What it really is the novelty is that there will be new ways of creating supply chains using North Africa, using Turkey, using Senegal even, and this would pretty much curb the government revenue of Russia.
As we talk about supply and demand dynamics, what does this mean in the context of China reopening? Because there's been a view that we've got the mainland market needing more product at this point, which could have potential to push up the price action. Are there implications as you piece the different factors together in the geopolitics?
Well, China opening is always a good story, primarily for the reason that if China really does open up and domestic consumption would go up, then all the previous policies that Beijing has stuck with, namely basically the nudging of domestic refiners into export markets, that would cease because their ultimate goal would change from basically stimulating the refining market to capping the domestic prices when consumption is high. We're still not in that level when basically they would start to deal with domestic pricing. But they will. I mean, we have seen it across every single commodity. The Chinese government is very, very interested in maintaining prices. So I don't really think that once China comes back, that there will be such a massive amount of Chinese product in the markets that we have seen in, let's say, November, December 2022. That was extraordinary, but that's not to be repeated.
Victor, can I ask you about non-OPEC plus production? Oilman magazine back in mid-January was talking about Canadian oil sands and whether most of the producers are looking at how they can increase output through 2023. It does seem that there is a response to these prices still in the non-OPEC plus oil production universe. What ultimately does that mean in terms of the headline crude price? Is there significant supply coming in from these other market participants to continue to keep prices low regardless of what OPEC Plus decides?
Well, my honest and completely frank answer would be that in the long term, I don't think that we have enough non-OPEC plus supply. Canada is a good story. Canada is the poster child of basically of the oil drilling company. It's the country where still upstream companies respond to whatever has been happening. But look into Latin America, which is also non-OPEC. Countries like Brazil, Colombia, Argentina, Mexico are all struggling to drill with the same pace that they used to. Africa, because of regulatory mismanagement, the same story. They're just not drilling enough. And I mean, one might not necessarily see it right now because, you know, oil projects have a long-lasting lifespan. But in 5-7 years, we'll gradually realize that this period from 2020 up until at least 2023 was a period when we didn't drill enough, and that was a huge mistake. And we will see the consequence because OPEC will concentrate its spare production capacity even more than it does right now. And we basically in the non-OPEC plus universe will just stick with structural decline as a normal normal event in life. Really.
Wow, what an ending, Victor. I will come back to you. I really enjoyed speaking to you. Yeah, we'll see this as a period of structural decline. I might even disagree with you on that one, but let's just see what happens. Very exciting. Really nice to see you today. Thank you for joining us, Victor. Always a pleasure. Viktor Katona, who is lead crude analyst at Kpler. Coming up on the show, India's security.